Welcome, my friends. What is up with Apple, you may ask? Well, something rare just happened. Apple shares were hit with a downgrade. When is the last time that happened? But, when you think about it, what has Apple really invented lately? In fact, what has any big tech company really invented lately? And, Apple iPhone 14 sales are rumored to be slower than expected. And MacBook sales are confirmed to be down. Let's admit it, the iPhone 14 is really not a lot different than the 13. And a lot of iPhone users are still on iPhone 11 models. So, what does this mean for Apple? What does it mean for big tech companies? What does it mean for the economy? And, what does it mean for the future of the United States? But, before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Apple has been a Wall Street darling for as long as most people can remember. But, this week, its stock was downgraded for the first time in a long time. Bank of America, B of A, downgraded shares in the most valuable company in the US to neutral from buy. The resulting sell-off vaporized $120 billion off its market cap. Apple's stock continues to be stronger than its big tech peers. Shares in Apple are down 20% so far in 2022, which is actually much better than most big tech companies. The Nasdaq Composite is down 31% in 2022. But, that does not mean that all Wall Street analysts are very optimistic. We see risk to this outperformance over the next year, Bank of America analyst Wamsi Mohan wrote in a note to clients. We are noticing weaker consumer demand. Services are already in slowdown and we expect products to follow, Mohan continued. Shares in Apple plunged almost 5% on news of the downgrade. Mohan revised her 12-month price target for Apple shares to $160 from the previous target of $185. Apple reportedly cut iPhone 14 production by 6 million units. The basic version of the new model is not much different from the iPhone 13, Mohan said. The iPhone 14's Pro and Pro Max versions are selling faster than the base model, usually the best seller. But even these premium versions aren't a massive deviation from their predecessors, because of the company's conservatism and risk aversion, Mohan also noted. Demand for the iPhone 14 in China has been slow. China is one of Apple's most important markets. Sales expectations based on pre-order levels ultimately disappointed, Mohan also said. Inflation is raging in most countries of the world. Central banks in almost every country are aggressively raising interest rates. And, now that there is interest on deposit accounts, investors are dumping stocks. Many tech names are down 40% to 60% in 2022 alone. And Apple has a number of other issues to contend with. There seems to be a lot of management turnover recently. Apple is facing an ageism lawsuit from one of its directors. And, suppliers to Apple are also weakening. For example, shares in Corning have been trending down recently. Corning reported weak guidance in its Q3 earnings call. Management blamed the weak guidance on slowing smartphone glass sales. Corning makes glass for the top electronics companies, like Samsung and Apple. Apple reports Q3 earnings this week amid speculation slowing consumer iPhone 14 sales. Maybe overall slowing iPhone sales will not hurt the high end of the market. We will see. Corning said downgraded revenue expectations from $3.55 billion to $3.75 billion. They said that they would need to see positive signs before upgrading guidance. Corning said that smartphone unit sales declined 14% year-over-year for Q3. Corning's largest business is in making cables for fiber optic systems. That business grew 16% to $1.31 billion in Q3. But display sales fell a whopping 28% year-over-year in Q3. And the consumer electronics slowdown doesn't seem to be getting better this year, Weeks said. We now expect smartphones to be down about 12% for the year, Weeks also said. And we expect notebook and tablet demand to decline 15%, Weeks added. We expect the year-over-year decline in smartphones, notebooks and tablets to be greater in the second half than in the first half, Weeks also noted. Corning reported Q3 revenue of $3.49 billion. And, if you follow this channel, you probably already know that tech companies are sensing weak macroeconomic conditions. It is fair to say that Q2 earnings were weak or weakening in most companies, aside from oil companies. Inflation is raging in most parts of the world. Central banks are aggressively raising interest rates in order to tame inflation. Consumers' budgets are getting tighter because of having to spend more on gas and food. So, consumer discretionary spending is weakening. Corporate marketers are cutting their ad budgets, especially online. And ad revenue is the lifeblood of many big tech companies. You probably all remember from the round of Q2 earnings announcements a few months ago. Google and Meta platforms reported decidedly disappointing Q2 earnings. Meta has posted shrinking revenue for 2 quarters and maybe a third quarter as well. And both companies promise to make adjustments in the future. Both companies have hinted at layoffs, but not actually made detailed announcements. Meta Platforms management promised cost cuts, hiring freezes, and ruthless prioritization. Meta has begun quietly pushing out a significant number of employees. This enables the company to cut a lot of positions without having to issue pink slips en masse. Analysts expect these reductions to be a precursor to deeper cuts. Meta is trying to cut costs by at least 15% by the end of the year. Meta has about 83,000 employees, which is 32% higher than at this time last year. Google has 174,000 employees, which is 20% higher than this time last year. Layoffs at big tech companies are big news because the biggest tech companies went on a veritable hiring spree throughout the pandemic. But the United States is now teetering on the brink of recession and the digital ad market has plunged. Shares in Meta Platforms are down by over 50% so far this year. And the market capitalization of Meta has fallen by over $685 billion since its all-time peak in September 2021. The market capitalization of Google is down 27% over the past 122 months. But not all big tech companies are adopting the stealth layoff approach like Google and Meta. Snap has publicly announced layoffs of 20% of its employees. This comes after Snap grew its headcount by 65% within the past year and a half. Google, Meta, and Snap are probably the most notable of the companies reducing headcount. But there are many others. This year, it is clear that Wall Street analysts are valuing profitability over prospective growth. As a result, unprofitable tech companies' shares are getting punished. And all companies are forced to either be profitable, find a merge partner, or die. The window for initial public offerings is effectively closed. That is why some Wall Street investment bankers are predicting a wave of tech mergers later this year. Twilio, another unprofitable tech company, is pretty much in the same boat as Compass. Twilio will take $90 million in charges related to the restructuring plan in the third quarter. It comes amid a broad macroeconomic downturn in the United States. The Federal Reserve is aggressively raising interest rates. And the United States is teetering on the brink of recession. Oracle, the worldwide software giant, has cut hundreds of positions but declined to say how many. Most job cuts are said to be in the customer service unit for U.S. customers. But what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.